Today I'd like to take a look at the performance of the S&P 500 in relationship to the economic growth that's taken place in the U.S. over the last bull market, and also take a look at where we stand right now with the COVID-19 crisis. If we go back and take a look using the Bureau of Economic Analysis data of U.S. real GDP annualized growth, we can see here that in 2009 we saw a negative value of 2.5%, which is what we'd expect at the time, and we've seen a string of positive values all the way up into 2019. There's no question that positive economic growth has helped support higher stock market prices. But if we compare this to what's taken place in past recessions, major recessions, typically you'd see strong economic growth coming out of that recession of 4 or 5% and see much stronger economic growth. We haven't seen that in this circumstance. We've seen economic growth. It's been fairly consistent overall, but it hasn't really been strong. In fact, the highest value we achieved was 2.9%. Now, so what's really been driving the stock market substantially higher in this time period? It's not just from economic growth. It's been two other factors that have been major contributors. The first one being corporations buying back their shares by borrowing cheap money, buying back the shares, making their PE look good and their stock price look good, helping to support the stock price in the stock market overall, which has been a major contributor to the stock market moving up. Given the COVID-19 crisis, the bailouts are taking place, and also too as well, just the overall economic conditions, we're not going to see a lot of corporations buying back their stocks. So that pillar of support has been somewhat or totally removed out of the marketplace. The Federal Reserve has also been a major driver in the performance of the stock market in this bull market, and that's well, we've seen them lower their interest rate, the Fed funds rate, down to 0 to 25 basis points in that time period, introduced quantitative easing. And there's no question that was a big supporting factor for the economy and the stock market here as well. But it became less and less effective over time, each of the programs. Now, the Federal Reserve has stepped up right now and gone back to introducing quantitative easing. They've lowered their Fed funds rate as well, back down to 0 to 25 basis points. They could go negative with it. I think it would be a huge mistake, given that the U.S. is the world's reserve currency. But they could do it. They've introduced some novel programs such as buying junk bonds and buying junk bond ETFs, and I'm sure they're going to do more as well. So governments have stepped up with fiscal stimulus at the same time. So the big bet right now is that the stimulus from the Federal Reserve and the governments are going to help to drive the stock market higher in this time period. But if we take a look at the GDP here, we're not sure what's going to happen with the GDP in 2020. This Wednesday we get our first look at GDP for Q1 of 2020 on April 29th. GDP is coming out, but that'll only include a couple weeks of the situation where the economy was in lockdown or quarantine. It's not going to have a huge amount of data points to represent what's been happening to the economy. We're going to have to wait a quarter to see that. So we can agree that there's some sort of hit that's going to take place to GDP in the short term. And the big bet is that everything is going to get back to normal and the GDP is going to go back to some of these values that we saw in the past, which will help support the stock market. That's not a for certain thing. There's a lot of positive narrative taking place out there in the marketplace right now, with companies starting to open up based upon government guidelines, and you've seen governments set forth more guidelines on an opening up basis. But given that we're probably already in a fairly precarious position or tenuous position with the economic growth really not supporting the stock market, and we could have some sort of hit in 2020 take place here. It really is a bet on the Fed, and that's a risky bet because we just don't know what's going to take place over the next while. And on top of that, we're coming into the 6-month period where the stock market tends not to perform as well in this 6-month period, starting May 6th until October 27th, what I call the 6-month unfavorable period for stocks. In that period compared to the last 6-month period as well. So it's not a time I don't think, to be jumping back in and saying, oh, it's all fixed, we can look forward and it's going to be fantastic and everything's going to open up great and it's for sure we know everything at this time. It's still a time to be cautious, particularly as we enter into the 6-month unfavorable period for stocks. Thank you.